Very warm welcome to everyone joining today. If you're regular on our webinars, welcome back. If you're here for the first time, it's great to see you. Hopefully you get something out of today. Today we have, it's an all-star Xact cast. My name's Phil. I'm one of the partners here in COO. We've got Noah, who's client director in our our compliance team. Suze and Josh are both partners in our compliance team as well. So we've got the big guns in here today because this is a tricky topic. So we're going to try and cover as much as we can. You may have seen our federal budget webinar where all of these sort of measures were first announced, these tax reform measures. We have some of them passed into law now, and the discretionary trust piece is still to come. So it's a bit of an update on that webinar, but if you weren't there for that one, hopefully you get a bit out of this session today. So in terms of housekeeping, what we're going to cover today is largely in law. So CGT and negative gearing have already been passed. There's some nuances in that, but we have some new law that we need to deal with. We are still wondering what's going to happen with discretionary trusts. It's with consultation at the moment at a federal government level. We're participating in that with Master Builders as part of their submission. But there's some still question marks about that. But it's important that we start to understand largely what those changes are going to be. As I said, we're using chat today. Please put your question into the room if you're comfortable to do that, because no doubt someone else is thinking the same question. And we all benefit from seeing those questions in there as well. We'll try and answer probably most of those in the chat as we go, but we might take a little moment to stop on a few of them to unpack them with the panel. We will be sending the video after the event, so you can ask that in the chat if you like, but I'm telling you right now, we're going to be sending that out after the show, along with any other resources we might talk about. We are going to be running some polls. Probably, I think today, not many, really just that first one was really quite useful. There is one at the end as well that if you want to talk to us about any of our services, you can put your hand up through the poll at the end. And don't forget, we have Xact resources on our website, which is where we host a lot of the previous webinars and tools and articles and all that sort of stuff, all designed on running a great business in construction. I've pretty much covered the agenda already. For those who don't know, we have 4 core services. Obviously, we do tax and compliance. That's what we're all about today. All about making sure that you are not paying a cent more than you really want to when it comes to tax, but also your assets are protected, particularly if you're doing things like your own property developments and that sort of stuff. Higher risk activity. Let's make sure that you can make the most of what's available to you through tax arrangements, but you're also doing it in a safe way. We do outsourced bookkeeping. Those guys know all the sorts of software that's available on the market these days and can help you make sure you've got really good, efficient data workflows and that you're tracking costs and all the like. Financial control is like having your own CFO, financial controller on a functional, fractional basis to make sure that you've got really strong financial reporting in the business to make much better data-driven decisions. They'll do things like your end-of-month close, your WIP journals, all that sort of stuff so that you don't have to worry about that. And they'll be your partner in helping make good decisions. And then ScaleX is all about either scaling your top line or if you're happy turning over, 5, 10 mil, whatever it is, and you want to improve the bottom line and improve your quality of earnings, that's what that team is all about as well. Okay, that's the promo stuff. I'm not going to run that first poll. It was really mostly about, what are you thinking about with tax reforms? But we pretty much know that people are very concerned about this stuff. So we might just skip right over that one. The disclaimer here is important. There is a lot of stuff happening in this space. It is really critical that you listen to your advisors, that your advisors are getting the information they need as well before you make any major decisions, particularly around restructuring or changing your business activity, because you heard that it was a good idea to do it down the pub or on current affair or something like that. This is a high stakes game we're playing here, and we need to be very well informed before we make any decisions. So please, we're going to give you general info today. Go and take that through to your trusted advisors so you can get some specific advice. Okay, that's it from me. We're going to go and talk now about capital gains tax, because this is, Suze, one of the areas that has already changed from a legislative point of view. Obviously, there's a timeline around how these changes are coming into effect, but CGT is changing. So if you wouldn't mind taking us through what that looks like, over to you, Suze.
Yes, Phil, capital gains tax is changing. For those that don't know what capital gains tax is, effectively, if you buy an asset, it can be any asset, a business, a property, shares, whatever it is, and then you sell them in the future for a higher value than you bought them for, that gap is your capital gain. And yes, we pay tax on that growth or that gain. So what are the changes? Where have they landed? There hasn't been a huge shift from where we sat when the budget announcements were made back in May. But we are very clear now the legislation has been passed and there are definitely changes coming. None of these changes will apply until the 1st of July 2027. So we have about 12 months under the current rules before anything changes anyway. So anything that you've got right now and you sell between now and 30 June next year won't have any of these implications come into play. They will apply under the old rules. So the old rules effectively said that any of that gain that you had would be discounted by 50% where you've held that asset for more than 12 months. That is what effectively is changing from 1 July next year. There is going to be a cutover period. So for the gain that you've accrued up until 1 July 27, that will stay in place and you can still apply that 50% discount where you're eligible. After 1 July 2027, CGT discount will no longer apply, but now we'll have indexation kicking back in. Those that have been around for some time may remember we did used to have indexation as part of our capital gains regime. Effectively, we're circling back and that's coming back into play. It is important to note new builds, and we'll talk more about what new builds look like later in this webinar, but new builds will retain that 50% discount eligibility post 1 July 27, but that's the only case really where that's going to still apply. So for building and construction, where we are creating new supply, that is going to be an attractive part of that, where we might still have that discount eligibility. Cost-based indexation, like I said, will apply from 1 July 2027. And we'll have an example coming up shortly that will walk through how this is going to apply practically. There will be effectively a 30% minimum tax on any post-indexation gain. So what that means is from 1 July 2027, any gain that you have after that point will attract a minimum 30% tax amount. And again, we'll walk through what that looks like shortly. This is going to apply to all CGT assets. And this is probably one of the biggest changes that has happened. Previously, anything prior to 1985, and again, for those that have been around perhaps a little bit longer, you might remember that's when capital gains originally came into play in Australia. We have exempt assets, what we called pre-CGT assets. So anything that you owned prior to 1985 was exempt from the capital gains system. That's no longer going to apply. So from 1 July 2027, if you continue to own those assets, you are going to be subject to some amount of capital gain when you eventually sell those pre-CGT assets. The exemption will be preserved up until 30 June 2027, and then any value that you have post that, that's what's going to have a gain applicable to it. Does that mean you need to get a valuation? Absolutely, yes. And that's our final point on this slide, is the automatic cost-based reset will happen at 30 June 27. So the government has put into this legislation a deemed sale and reacquisition at 30 June, 1 July 2027. So whatever the market value is at that point will have to be taken into account when we're working out what any post or pre-gains look like. And the only other comment I wanted to make on this slide, and again, we'll talk a little bit more about this in a moment, is the small business CGT concessions have been preserved. So that's where you have a small business asset. There was a separate set of capital gains rules that you could apply to reduce your capital gain on the sale of a small business asset. Or small business and associated assets, that is going to stay. So that has not been affected at all. There has been a couple of minor changes, but we'll talk about them shortly.
Okay, so that's the kind of, they're the changes in bullet point form. We're now going to walk that through when it comes to a practical example.
Exactly. So the situation we're describing here, we have a builder, has a family trust, and in that trust bought a commercial property in 2015 for $400,000. The market value at 30 June 2027, and yes, he's gone and got a valuation to prove this, it was $700,000. The trust then sells this commercial unit in August 2029 for $760,000. So in raw numbers, the sale in August 29 of 760 minus the cost in 2015 of 400 gives us a gain, or that capital gain we're talking about, of 360,000. At the 1 July 2027 mark, we've got two things we've got to look at. So our pre-30 June 27 gain, 300,000, the 700 back to the 400, and then our post June 27 gain of 60,000, which is from the 760 in August 29 back to the 700 market value at 30 June 27. So how does this all play out with the new rules? Here we go. So we've got 2015, we've bought this property for 400,000. It's a commercial unit and it's being used in the business, and that will come into play shortly when we talk a little bit more. We have revalued, or under the legislation, we have deemed a new market value of 700,000 at 30 June 2027, and we have a valuation proving that. And then we've eventually sold this property in 2019 for 760,000. So under the current regime, our old 50% discount will apply. So that first 300,000 growth that we've incurred up until 30 June 27 will retain a 50% discount applicability or eligibility and give us a taxable amount for that first portion of 150,000. So that's locked and loaded. At 30 June 27, that's locked in. We only have to pay tax on 150,000 up until that point in time. The next part, so post 30 June 27, indexation is going to apply. Now, indexation is an interesting one. We can't specify what those rates look like right now because indexation is based on what the real CPI rates are post 30 June 27. So this is going to come into play post 30 June 27. Every quarter, we're going to have a published indexation rate that will apply to a gain that happens at that point in time. Some people may remember we used to have tables of this. We'd have to look up tables some years ago and say, well, what, we've sold it at this date, what's the rate? And there was all this big mess that we'd have to try and work through. So we're kind of going back into that phase. Hopefully we've got some good calculators that the ATO will roll out to help us with that. But effectively, we're not going to be able to physically calculate those accurately until we've got those published rates. So what that means here is our gain between June 27 and August 29 is 60,000. Our index rate, we're assuming about 2.5% in this example, gives us a post-gain value on the gain of 35,400. So that's our indexed amount from the cost base up to the sale price, giving us a taxable amount in that post period of 24,600. Now, that 24,600 will have a base 30% tax applied to it. We can't just take that and say that's our gain. We have to include that original 150,000 from our pre-30 June 27 as well. So our overall gain for this whole asset is going to be 174,600 with a minimum tax payable on that of the 30% of the 24,600. So we've got 150 to deal with and a separate amount of 24,600. So on a $360,000 gain, we will be paying tax on an amount of 174,600 with a little bit of an adjustment for how that works on the 24,600. Now, as I said, this is just an example, assuming an index rate of 2.5% at the time of sale. You do also have to take into account marginal tax rates in terms of who the taxpayer ultimately is that pays this tax. And that will determine whether that flat 30% on that final piece is 30 or more or not, or something else. So it's either going to be minimum of 30 or it could be more if the tax rates are higher under the person who's actually paying the tax on this amount. So it's a very sort of simple example just to explain how this post and pre amounts are going to work. And effectively as well, it's interesting to note that in this example, that 50% is almost retained. So if we'd sold the whole property without these changes for 360,000 gain, we would have paid tax on 180,000. So this has kind of fallen out fairly similar to what it would have been if the 50% regime had continued. Again,
yeah, there's a fair bit of, obviously with a lot of these changes, there's a fair bit of conjecture going on around how it's going to impact people and their decision making. This is just a basic example. There are going to be, obviously, over time, this is a phasing in, and so how indexation plays out with various transactions is going to, vary based on the nature of those.
100%.
But with this example here, it's sort of net effect, quite a similar kind of outcome.
Correct. And it is going to be very much case by case, and everyone will be looking at an asset in its entirety to work out what the actual impact is going to be for you as an individual person with assets like this going forward. So it's very critical to have a look at each of the cases on a case by case basis and not just take general information to work out how these things go. So key takeaways in this example, or in general in relation to these new changes, every asset held at 30 June 2027 will be deemed sold and reacquired at market value. You don't pay the tax at 30 June 27. It will be deferred until the final eventual sale of that asset, but it is effectively reset at market value at that point in time. That is an automatic reset. This is not optional, so you will have to look at market value at that point. No, as I said just before, no tax is payable at that date. It is deferred, but it is important to know that we will need to look at market value and have valuations in play. Can we backdate, or can we go back and get valuations post that? Yes, we can. So it doesn't mean everyone has to rush out and get a valuation on 30 June next year. You will have time to pull those together, but it's important to know that we will need them. The years of accumulated growth, so if you've bought it like we had in our example in 2015, that has actually effectively been shielded under the new rules by giving us that cut-off point at 30 June 27. As I mentioned before, the ATO will be providing the indexation rates. We can't tell you what they are right now, but that will happen as CPI plays out over the coming years. And as we mentioned earlier, CGT small business concessions are preserved. So in this example, it was a commercial unit. If it was being used in a way that treats it as a small business asset, that unit could have avoided some of these issues by applying the small business concessions, as opposed to running through this regime with indexation, etc. So they are preserved and will retain the nature of those going forward. Now, as we said, small business concessions are preserved. There is a slight change to the way these are going to play out. And for those that are familiar with the terminology, it's not a big deal, but 50% active asset reduction is one of the concessions that applies. We used to have a turnover threshold for that to apply of 2 million. That has been now increased to 10 million. So that's a huge increase in terms of more businesses are now going to have greater access to these concessions, and specifically the 50% active asset reduction going forward. So that is a good win for a lot of business owners in this space. So as I said, a lot of construction businesses will now fall within this threshold. So it's a great win. So what does this mean for you? Growth that you've built up until 30 June 2027 in any of these assets will keep the current treatment. So you will be able to apply the 50% discount if you're eligible for it. Small business concessions will continue to apply if you're eligible for those. After 30 June 27, we do have this new inflation rate that is going to apply, and we will have a 30% minimum tax that is applied to that value as well. So we do need to look at those market valuations at 30 June 27. As we've said a few times, small business concessions are still in play. That has not changed. Trust tax, and that this is coming up, and we'll do a fair bit on this down the track today, that is separate. So capital gains values and the tax on those is completely separate to the way the trust is taxed, or could potentially be taxed as well. Always important to know the figures we've presented today are illustrative. You do need to talk to us before acting on those numbers and get advice specifically for you in relation to your assets as well.
Okay, awesome. Thank you, Suze. Important changes coming through there. Some of them are going to bite in terms of what people's future position is going to be. For others, it will be more of a mixed kind of outcome. There are actually some opportunities within that new framework for improved positions. So, we're not going to get bogged down in the minutiae on that today, but certainly it's not a complete loss scenario moving forward. Your advisors are supposed to be there to help you wrangle whatever fresh legislation comes out to your benefit. So please talk to your advisors on that. Okay, negative gearing. Noah, we're going to throw to you now to talk through changes in negative gearing. So we're just going to, for anyone on the call who doesn't know what negative gearing is, we're going to do a quick explainer on that just to set the floor. So this is the beginning of this tale we're going to tell. Noah, over to you.
Thank you very much, Phil, and thank you, Suze. So negative gearing, it's been a part of Australian tax law for a very long time, as well as property investment. So some big changes here. This is law. So negative gearing is where you have a investment property and the expenses or costs that you incur to hold that property outweigh how much rental income you get. So effectively, you're making a loss on the rental aspects of that property for that year. Now, with negative gearing, you can currently use those losses and apply them against your other income in your tax return. For example, your salary and wages. So massive changes here that we'll run through. So we'll just give a bit of an example on this. So we've got an investment property. The rent received for that year was $30,000. Our costs to hold that asset were $42,000. So we have a shortfall or a loss of $12,000. So costs include interest on loans, council rates, water charges, all that kind of stuff. We've got a loss there at the end of the year. Our other income in our tax return is $180,000 of income from our wages or business income, whatever it is. We have $12,000 loss from that property. We can then use that loss and apply it against that taxable income to reduce our taxable income down and effectively reducing our marginal tax rates and subsequently the tax that we incur there. So we're saving about $5,500 here by using negative gearing, and effectively we could get that back as a refund in our tax return at the end of the year. So in the Australian property landscape, especially the resi side, it's all about capital growth. And this has been an aspect of why negative gearing has been a big part of investment strategies for a long time, is that we can also get a bit of tax advantages here from incurring a loss in that property. So these are changing. The next slide we've got here shows how this is going to work. So from 1 July 2027, the 28 financial year, you won't be able to claim negative gearing on properties. So if you've owned this property prior to budget night, you're grandfathered, or what that means is these rules won't apply to that particular property that you've held. So you can continue to negatively gear that property. If you bought the property between budget night, 12th of May 26 and 30 June 27, which is the last period where we can use negative gearing, you'll be in that transitional phase, which means you can still apply it for that particular financial year. The changes do come in from 1 July 27. So if you've bought it from 1 July 27, you are outside of this area and you won't be able to use negative gearing against your other income. Important to note here, though, that you can still claim rental deductions against your rental income, but once it gets to zero or to a loss below zero, you won't be able to use that to offset other income. And another key aspect here is that negative gearing is still going to apply even after 1 July 2027 for properties that are newly built. Pretty big aspect here for our client base and a lot of the construction owners out there, so something to consider as well. So that's the key aspects there. So there is a bit of an advantage here with the new builds. So this will apply from 1 July 2027, full negative gearing on those contain and continues on. You can also, as Sue's mentioned before, elect to use the 50% CGT discount on new builds. Thinking that this may likely, redirect investor capital to new builds rather than having, properties that have been sitting around for a while that we could renovate slightly and still claim negative gearing. This is only going to apply to brand new builds and starting new properties, which is a key bit. It must be new stock, not just replacing the old property that was already there. So we've got a nice slide next here, which gives us a bit more detail on what's eligible for a new build as well as what's not eligible. So anything off the plan in terms of an apartment complex where we've got brand new buildings that has been built and there's many apartments there, that qualifies as a new build. Knocking down a freestanding house to build a duplex or townies. So we've had one property before, we've now got 2 or 3 that those qualify as a new build, and you still can use negative gearing for those. If we have vacant land and we're building a house or townies or a duplex on that, will apply. And if there's been a sale within the first 12 months and it's been held for less than 12 months. So basically anything that makes more property on the market is going to be able to be used there. So subsequently to that, things that are not eligible is just do an extension on existing property. Knocking down an old property just to build one dwelling, that won't count as a new build. So that's a key aspect there to keep in mind. Adding a granny flat or another dwelling at the back, but it's still part of one lot. I know it's a bit more technical, but it looks like that's not going to apply. And anything sold after the 12 months of occupation as well. So massive changes there coming from 1 July 27. But yeah, interesting to see that we've got this new build aspect in there, Phil.
Yeah, absolutely. And I think, obviously these changes are underpinning them is this idea that it's going to stimulate, new homes growth, and that any, productive output from the industry is being directed that way. So certainly the investor-led market, you could assume are going to have a much higher appetite for that sort of activity, new builds, particularly where they want negative gearing to continue to apply. So it really just depends on what your business model is. But for those, chasing this as an ongoing opportunity in our tax system, really it's going to have to be new builds in terms of new activity that's moving forward. Okay, excellent. Thank you very much, Noah. We are now going to move to Josh, who's going to take us through probably the chunkiest area of change in amongst this suite of tax reforms, and one that we have to make very clear has still not come to pass. And what shape it finally takes, we're not sure as well. There's a lot of discussion and chatter around political ranks in terms of, whether this goes through with the Green support as the other measures have. What happens if there's a change of government? If it does come in, it'll get reversed, all those sorts of things. All we're going to do today is just talk through the shape of these changes as we know them to be right now. And we promise to keep you informed, as things evolve in this space. So, Josh, this is not insignificant. Usually budget announcements go through fairly boringly. This is not one of those sort of announcements. This is wholesale change, probably the biggest we've seen since something like GST.
You are definitely right there. Just a really quick one on the chat. I've just seen it come up a few times. If you're asking a question, can you make sure you're on everyone, please, guys, when you're asking a question, because it's coming to us as hosts and panelists only, just so everyone's getting the benefit of the question answer as well. As Phil said, trust reform. So if the above two things that Suze and Noah weren't clear as mud, this will be even more opaque to a degree as well. But Phil is right. I think this budget that just went through would be the most significant one that I've seen in practice. And GST is probably the only thing that compares to it, to be honest. The only thing about some of these changes is it's a little bit more grey area than what GST was, because at least they consulted and helped roll it out. So this one's a bit feels a bit wild. So, and there's a lot of discussion around this, and I just want to sort of set the record straight. People shouldn't be getting unnecessary anxiety around this, because admittedly there's a bunch of things that we still need to work through. The final shape of it will be different, and there is a little bit of time to work through this as well. So let's just sort of walk through the broad framing of this trust reform that came to be. And the baseline of it is that they're aiming to have all trust related income coming through at 30% minimum tax for 1 July 28. So that's the that's the sort of core benchmark that they're sort of getting to, that we want people to be paying at least 30% on income coming through trusts. Now, that 30% is a bit of a confusing mechanism, but essentially the trustee of the trust, or the trust itself, essentially has to pay this 30% tax first. And then whoever benefits from the trust has this credit that attaches to it. So it goes to individuals. So individual and other trusts have this pass-through credit. It's not refundable. So that's one sort of mechanic that's a bit odd, and I won't go into the technical. The big one that we're going to unpack today is that the investment company or corporate beneficiary or bucket company, as we use, that one is the one that's been very heavily targeted in this. And largely, if this comes through, it's somewhat rendered those entities in their current form unusable because the tax rate is just prohibitive. So there are some carve-outs from this. So self-managed super funds, they have just recently, because when it first came out, there was ambiguity around testimony trusts. They have corrected that now. So testimony trust will be carved out, and there will be some carve out for primary production. But again, we're waiting to see all the specifics around that. Now, the trust has been used for a very long time in this country, and I think recently we did a bit of a data set check ourselves, Phil, and a very, very big percentage of our client base use a trust, right? So
yeah, I mean, we're heavily in building and construction, and it was something like 70% of the family groups that we look after have a trust somewhere in that structure. Yeah.
So like a very large percentage have this. And so what's been the whole use of trust in the first place? The income splitting and flexibility. So that concept of people have trust, have flexibility. Well, that flexibility has just been largely narrowed. And the ability to sort of split income through a family group has been quite dramatically changed. So there's two modes, and we'll work through this today. We've got people who operate in a trust, so the actual business runs in a trust, or they've got an operating entity that has a trust connected with it as the owner. So there's a few pathways here that we're going to walk through. Basically, do we just stay as we are in Coppet? Do we restructure? What are we going to do here? Knowing that the government has proposed a 3-year restructuring window for this from July 27 to 30 June 2030. However, we might unpack some other elements that the government may have strategically not bothered to address as part of that restructuring window and relief, because it's not as amazing as it might sound. So let's have a look at the most common structure we see in our businesses that we're working with. So we sort of have a trading company. So we're operating in a trading company. Some do or don't have the holding company, but that's still a very common structure we're using these days from an asset protection. And ultimately, that group of companies is owned by a family trust or discretionary trust. And very common flow is that a dividend comes out of the profits of that trading entity, goes through the trust. We distribute it between husband and wife in this case. The key flexibility being you might have one person in the family group who's on a much lower income, and so you stream that way. So that's the sort of baseline structure that we'd see a lot of the time. And so let's unpack what that means under these changes. So the current rules, just quickly, we have a sort of $100,000 profit that we've made at the trading entity before tax. Most small businesses pay tax at 25% in the company. So that sort of flows through. So what's been happening present day is we have this 100,000 flows through. We've decided to distribute that to the wife from that example before, because the only other income the wife had was about 20,000 other income. So we've streamed it to the wife. That franking credit comes through. So we're looking at a overall tax of about 28 or 29%. Now, under this proposed rules, this might look like it's not too bad, but there's some hidden detail in all of this. Is under the 30% minimum tax, same flow, distributing to the wife. There's a baseline 30% that's being paid on all of this. And so when you're looking at it side by side, it might not look that scary as a concept. but that is in that very narrow set of circumstances, right?
Yeah, that's right. This is an example where there's almost no impact at all, and it's important to point out that there will be some people that land in this bucket, no doubt. There will be some where their earnings that are coming through the trusts are already once distributed out in excess of 30% marginal rates anyway. And so in those examples, there's a sort of net effect of not a whole lot.
Not a whole lot, but there's a trap
coming through.
Yeah, there's a bit of a trap here because this is somewhat of a perfect scenario to show this outcome. But if any of those variables through the trust slightly change, and we have this concept of franking credits that attach to dividends in this country. Now, the way this mechanism works is franking credits under the proposed rules kind of became trapped. So under our current system, if the franking credits that you receive via a dividend actually exceed your tax rate, you get the difference back as a refund. In our system, they're refundable. This new mechanism, though, the trustee burns through the franking credits first as part of the 30% tax rate. And so if there are any excess franking credits as part of this process, they actually evaporate. That's the problem. So there are some hidden nuances in this where in some cases, what has been a refundable franking credit world in Australia has actually just been reversed via a different mechanism.
That's right.
And so that's the hidden element to this that I just wanted to make the point, because you don't look at it and go, oh, it doesn't seem that bad. In that particular case, I agree, but it's a bit more complicated than that.
Okay, so let's move on to what is I guess, almost not an option under these proposed new legislation around the discretionary trust, which is where you have an investment company, often referred to as a bucket company, as beneficiary. So let's walk through that structure as it currently stands today and how that.
As it currently stands. So this is the flip structure where some of the attendees today will be trading in a trust. So the trust is the operating entity generating business income.
Probably not in Queensland because of QBCC and the way that those regulations work. If you're outside Queensland, then trading in a trust has been
common.
One of the options at your disposal. I mean, we could almost think about this as a trading entity above the trust as well. The nuances play out a little bit differently. So sort of in theory, there's a similar treatment to the example we had before, where you had trading company above, owned by trust, and then beneficiaries underneath. The main difference here, I guess, Josh, is that we've got a bucket company underneath.
Yeah, an investment in it. Yeah. Either way, it's income coming via trust, and we don't want to overcomplicate it. So the income coming through. So what we would do at 400,000 is we're distributing 120 to spouse 1, 120 to spouse 2, and the balance 160, we're moving the benefit and distributing to a bucket company. So present day, really high levels, the marginal tax rates will be paid on the two 120s, and then the bucket company receiving that distribution from the trust, tax at 25% and investing the money in there. So the total tax under that scenario, we're at 97,304 from 400,000 worth of distributed income. So that's present day. This is where things got a bit gnarly in the reform, in that bucket companies are essentially being targeted as we don't really want that to happen anymore under these changes. So
pricing it out of the market, basically.
We're pricing it out of the market. So same concept. We've got the same sort of income. However, the bucket company, that mechanism I was talking about before of the trustee pays the tax and there's a credit attached to it, the bucket company doesn't get the benefit of that credit that the trustee pays. So what do we end up with? Probably one of the first times I've seen in a long time where there's a double taxation back in our tax system. So it's paid at 30% at the trust level, but then it's paid again at the bucket company level. So you'd be an effective rate of 55% under the new rules distributing to an investment company, which is madness. And so basically, if you continue doing that under the new rules, you'd be nearly 70 grand worse off annually, which is material, very material under these changes. So what do we have to look at now? So one thing that the government has sort of proposed to go, well, if that's the case, we'll give you restructuring relief, which sounds amazing. Yeah, thank you. Not that simple. And so say we do restructure it out of that trading trust and we move back into a trading company. What have we ended up with now here? So one thing that it's sort of cautionary as part of these changes is in a trading company, you might think, oh, well, we'll just put the two spouses on the same wages and move on. Well, it's not as simple as that, because wages in a company need to actually inherently link to the activity that person's actually doing. So if you've got someone who's not working in the business at all and you put them on a $120,000 wage, you're actually taking a pretty big risk, because that wage, if you really look at it, doesn't connect to the company. So the company wouldn't get the tax deduction for that wage because of that nature, that's not inherently connected. So you'd still have to pay tax on it. So because of that quite important nuance in this, you might end up in a scenario where that sort of 120, that whole 240 has to go to the working spouse, and the non-working spouse isn't allowed to be on wages. And so that scenario where we were distributing 160,000 to a bucket company to invest, and have some asset protection as well, that now stays in the trading company if we don't want to make our tax position horribly worse. So with a restructure, we're back to not paying the 165,000, but we've now got 160,000 that's more at risk. We are still now paying 21,000 more tax a year permanently, and that's restructuring into the company, assuming the restructure happens nice and neatly, which is the key component to this overall. And we're about to go through some more complexity around the restructure. But here's this sort of side-by-side comparison of what does this look like.
And these are just the scenarios we've walked through. It's just it's impossible in a webinar like this to go through all the different permeations of what you could restructure into and the tax implications of those. We've just gone with some basic examples that we can share today, and this is the net impact of it, of what your tax is going to look like. This is where it would currently sit today with that investment company option at the bottom. If you are under the new rules at the double taxing option, you're paying 164. So you're giving the government more than you're keeping. Which obviously no one will want to stay in that option. So the restructuring is going to have to come into play. And there are the two different options. One where we keep the trust and it goes out to individuals, and then one where one of the spouses is working in the company. So that's those sort of various scenarios in a comparison there.
And so the point we want to make, particularly around the restructuring in these proposals, is whilst putting the red panel out of the equation, the 164, let's put that to the side. The other ones on face value don't look horribly different to each other. But the point we want to make is the government is saying, well, you should restructure, but that's way more complicated. Everyone on this call knows how hard it is just to set a bank account up for a new entity in this day and age, let alone try and move your entire trading activity to a different entity, right? And so that's why in the bottom case here you go plus a one-off cost of we don't know to restructure, right? Because
so let's go through that, Josh.
Let's have a look at that now. So here are all our elements that need to be considered when you're restructuring out of trust. So we're talking about restructuring out of a trading trust, in this case, into a trading company, right? So the key thing here is, whilst there is tax relief at a federal level, don't assume that all the state governments are following the same tune, because they're not. And so one big thing is that stamp duty is quite an expensive standout cost that could smack you in a restructuring event. And it is quite complex and can be very expensive if you don't get it right. And that's why we put that in red, because that element is not covered by the rollover relief.
Yeah.
And so then you've got all the other elements, like there are complex legal and accounting areas to make sure you can do that restructure properly and not trigger surprise tax outcomes. That requires a lot of planning. And I can tell you now, restructuring a business, and every time I've done this, it's a good 12-month process every time, because there's always trailing elements that need to be dealt with. Particularly if you're in building construction, doesn't matter what state you're in, you're still in a new licensing and approvals, whether it's by insurance, ICAS or BBC or even QBCC, you have to tick all those boxes again. If you've got contracts that are live at the time you're going to restructure, we're going to go through, can we novate them? How we're going to novate them? There's legals on that. Not to mention everyone's probably got some sort of site signage, even your banners going around your fences. They've probably all got something that's got your QBCC license number or ABN on it. Well, that's all got to change. And everything else around finance, lease consents and registration. So the restructuring out of a trust isn't a simple issue. And the one that we've really sort of honed in on, particularly through the consultation process with master builders as well, is all those other areas, commercial areas that actually get impacted. A lot of you will know, particularly if you're working for clients that are using banks, etc., everyone looks at history. So if you've now just gone and reset the clock on your commercial history, license history doesn't exist anymore, your ABN's only 12 months old, there's a home warranty hurdle you've got to jump over, because we know the likes of HBCF or ICARE down in New South Wales, you can't just immediately get exactly the same threshold you had in the other entity. All of those areas, and some people will start getting commercially a bit worried about why you're restructuring. This concept of are you financing something, and as well, yeah, and you're right, Paul, as well. Like employees, all of those elements. There's
employee contracts have to be moved across. So
100%.
It's all well and good for the government to say we're going to give you some relief through the tax system to help you out with this restructure if you need to do that. But there are so many other factors that need to be considered when you're doing the restructure that often will have a cost attached to them. If not, the time it takes. I mean, Josh is saying, at least 12 months to do the restructure. We also need to consider all of the brain power that's required from you and your business and your partners, etc., to understand and work through the arrangement. It's hours and hours and hours. So I know we weren't going to get political, but if you do have a local member that's a Labor Party, you should have a chat to them right now about these changes, because it seems that all of that activity is wasted when we're in a housing crisis situation at the moment, and we actually need more houses built, not stuffing around with this sort of regulatory change. Exactly. That's not a view of the company. That's just my view personally about how this is all unfolding. Okay, so that's the cost arrangement that or the various sorts of costs that need to be factored in when it comes to restructuring. The stamp duty, I think you've covered that well already, Josh. So we might just move now to just this timeline. If you just want to take us through the timeline, we've covered a few different changes and how they roll out over time.
Correct. Yeah, we sort of covered off on this, but this is just that last sort of visual. So, so in some elements, we're just trying to stop people knee jerking and panicking too much with this timeline. So the negative gearing, Sue's spoken about, that's cut off from that point, and that really kicks in from July 27. There is some instant asset write-off stuff that's been baked in now from 1 July 26. So the 20,000 threshold is now a permanent feature. The loss carryback. I won't go into detail on that one today, but it's basically a sort of, if you have some losses in some future years, but you pay tax in prior years, you might be able to carry back those losses and claim back the tax you paid. But really, our core starting point in our timeline is 1 July 27 is when things really kick off for the CGT and negative gearing piece. And that's when this restructuring window opens, albeit we really don't think it's that great. But the trust element that we've been talking about is really a 1 July 28 triggering point. So from that point onwards, it becomes a problem. So there is a decent amount of time, particularly on the trust stuff, to plan properly around this. So you'll be working with advisors to really map it out. What are the pathways? There'll be multiple pathways, and this is case by case. There's not sort of, hey, we just need to do this restructure. No, let's just, you have to look at it carefully. With 30 June 2030 being this closure of that restructure window overall. So they're sort of, in the space of a couple of years, it's pretty big changes coming, and the good thing is a lot of it has a bit of time to just properly plan it out without having to knee-jerk it, although time will be upon us for 30 June 27. So
yes, and we do, I guess, we empathise with people who are in the middle of transactions, thinking to purchase property, thinking about, restructure for other reasons, and what those decision settings need to be, given that we're in this imminent state of transition here. So again, it's very, very important that you're getting good advice on this sort of stuff at the moment, given the state of flux that we're in.
Yep. Do you want me to answer a couple of questions there, Phil?
Yeah, what I'm going to do is, because we've got a little bit of time here, so I'm just before you do that, I'm going to launch our next poll. Now, this is the one I mentioned at the beginning, where if you do want to have a chat to us about any of the services we provide, you can do that by just answering this poll here. So the first one is structuring my business to minimize tax and protect assets. Well, that's fairly relevant for today's topic. Outsourcing my bookkeeping to an industry specialist. So, if you feel like maybe your current bookkeeping arrangement isn't giving you the clarity that you need in terms of data and job costing and all the rest of it, and having people who understand all the tools, there's that option there. Engaging a fractional financial controller. So this is, like I said, good financial reporting, being able to have your end of month done for you. So close the books, understand where WIP is going to land each month, which is obviously very critical for understanding your profit position, etc. And then the other part of it, which is ScaleX, having this experienced advisor alongside to help you on the growth journey. So I'll just leave that up there while you guys answer any of those other questions that you feel. Josh, maybe you had one in mind there.
Yeah, it's come through the host and panel, so I'll just jump on it. So there's a question around, are unit trusts impacted the same way? That's an excellent question, and this is actually a very grey part to this whole reform, is without doing a lesson on trust at 11 a.m. in the morning, unit trusts, there's a concept that fixed trusts, this phrasing of fixed trusts were carved out of these changes. But fixed trust is very specific on what it means. And I can tell you now, by and large, most unit trusts in Australia are not fixed trusts. I think there's only about 6 or 7 in the country, Noah, that actually exist, something like that.
Spot on, Josh.
So unit trusts, essentially, most of them are going to be impacted, unfortunately. And so that's one thing that we will be working on as well, in terms of what are the options available. Is there has been some conversation around whether unit trusts have the ability to convert to fixed trusts, but that's a very complicated piece. Graham asked a question on what happens to Division 7A loans.
Yeah, I was going to say, while we're talking complicated, how about Div 7?
Division 7A loans, that's probably it's a fairly broad question in terms of like moving forward. Division 7A is still applying for anything that's existing. The only thing that might be changing in the next couple of years is that distribution to bucket companies, etc., and how Division 7A applies. That's pretty complex because in conjunction with the federal government's announcement, a very important case went through Australia around distributions to buffer companies and the unpaid present entitlement. Short answer is nothing specific happens, Graham, to Division 7A loans, but there might be some changes to how Division 7A arises in a group moving forward.
I've just put up our next masterclass is cash flow clarity. So this is going to be run by our advisory team. This is the fractional FC, fractional CFO team. This is all around how do I get better clarity around cash flow and breaking the cash flow cycle, further upstream, so that you never really ultimately have to be concerned about the bus hitting you didn't know was coming. In terms of other questions there's the property valuations, I think is going to be something that people are going to be concerned about. How does that work? When do I get them done? Suze, I know you sort of covered that in your part of the session today. Valuation work, I guess it's one of those areas where people are going to be run off their feet, but it doesn't necessarily have to be rush out and value on that particular date, right?
100%. Yeah. So you do have some flexibility around that. Evaluation will be needed, but doesn't have to be at 30 June on the dot. You will have some time post that. I would say either side. Post that to actually get evaluation underway and in play before you sell the asset.
Okay, we are coming right up on time, and we do like to be punctual with these webinars. People have got things to be out there doing. So thank you very much, Noah and Suze and Josh, for your expert coverage of that topic today. It is an unfolding feast for everyone. So like I said, we promise to try and keep you guys informed. Stay alert and keep your eyes open for our next webinar, that cash flow webinar that we're running in August. And also, once we have some more detail around the way the discretionary trust piece is going to unfold as well from a legislative perspective, we'll track back to this topic. I think we'll do a single webinar just focused on that particular aspect by itself. And there's a survey at the end, guys. If there's anything you want us to cover in these webinars, please let us know in that and give us a bit of feedback. We're always wanting to make these webinars as good as they can be. So thank you again for joining us, and we hope you stay safe out there and go well. And if you need a hand with anything, you know where to find us. Okay, thanks, guys. We'll see you next time.
Thanks, everyone.
Thanks, everyone.
Bye-bye.